Let's check in now with Craig Bolanos, the CEO and founder of Wealth Management Group. Craig, traders are still concerned about the potential of a taper tantrum tied to the Fed and the economic recovery. But what should investors do to prepare?
That's right, Angela. If I had $1 for every time I've seen a reference to the word taper over the past year, I'd be retired on an island. So let's seek to understand what the word taper actually means and what investors need to do about it. Well, when the economy literally came crashing to a halt, as it did during the pandemic of 2020, the Federal Reserve, our central bank, found it necessary to perform various forms of QE, or what we call quantitative easing, through a combination of financial strategies. The two most prominent strategies: lowering interest rates pretty much to zero, and also doing something we call bond buying.
If the Fed is going to taper soon, doesn't that mean that interest rates could shoot up and stocks could have a negative reaction similar to the last taper tantrum of 2013?
Well, anything is possible. We need to understand that investors and hence markets are well aware that tapering, or the reduction of monthly bond buying, is going to occur, and hence no one should be caught flat-footed when this event actually starts to happen. And that's in stark contrast to the then Fed Chair Ben Bernanke's comments back in 2013 that caught everyone by surprise. Now, since that event, the Fed has learned its lesson. The Federal Reserve is incredibly measured and intentional with its messaging, so this should be widely anticipated, and that's one of the core reasons a taper tantrum should not repeat itself. However, investors can and should use what's going on in the news today as an opportunity to reflect on their current asset allocation.
So what are some of the sectors that investors should be considering?
Well, I'm glad you asked, and there's really four things that come to my mind. The first is the asset class called small cap value. It's been overlooked, it hasn't been loved of late, but small cap value stocks tend to perform in a growing domestic economy. And by the way, the index for small cap value stocks happens to be loaded or constructed with many financial companies, and those financial companies are going to stand to benefit from a rise in interest rates as it helps those stocks grow something called their net interest margin. Number two on the stock side is just higher dividend yielding stocks. Those can continue to benefit as income-loving investors are just going to be looking for better options. And by the way, a growing economy might just further improve the dividend health of corporate America. On the bond side, the fixed income side of the portfolio, what I think about in today's market is a concept like senior loans or bank loans. Those are bonds and bond funds that pay a spread over benchmark rates such as LIBOR, and senior loans tend to do well in a rising interest rate environment that oftentimes comes with a growing economy and higher inflation. And then last but not least, I think about TIPS, Treasury Inflation Protection Securities. Now, since inflation is rising, TIPS could continue to be a winning bet for those looking to hedge the more eccentric, exciting parts of their fixed income portfolio, aka the senior loans I just mentioned. I'm Craig Bolanos, the CEO and founder of Wealth Management Group. If you'd like to learn more, you can. Go out to our website, investwithwmg.com.
Go to businessfirstam.com for where to see our show on TV.